We'll now move on to our last presenter, and who's come all the way from the US. I should have said our presenters have come from multiple jurisdictions to be here today, and Ted is no different. Ted is the CEO of Engage BDR, and I'll pass over to Ted now to give his presentation. And remember, if people do have questions, just use the Q&A function at the bottom and we'll get to those questions at the end. Ted, over to you.
Thanks, David. It's good to see you again. And we spent some time together a couple times, and I think in Sydney and Melbourne, I think a couple years ago. So good to see you. I'm Ted Danik. I'm the CEO and chairman of Engage BDR, EN1 on the ASX. We've been listed on the ASX for a couple of years. We're just coming off of an incredible year. 2019 was pivotal for the company. It was a profitable company, profitable year for us from an operating EBITDA standpoint. And we were on our way to we're about 300% of 2019 year to date. And then COVID hit, but we are doing much better than anticipated, or the industry is doing right now. So to give you some insight, we can start with the first slide. There's some disclaimers here. We can get past that. Essentially, we've developed a proprietary technology, which is artificial intelligence and machine learning, which automates and maximizes the transactions of digital video, native and display advertising and influencer marketing for advertisers, their agencies or their ad agencies, and app publishers who display these advertisements. So very specifically, we play in the mobile app space and also connected television, which is where all of the ad budgets are headed, probably in Australia soon, but here in the US, all of television has become digital now, and connected television is where you advertise there. So we are an ad company, essentially, specifically on apps. So we don't do websites. We don't market on websites and other content places like that. It's a $108 billion business today, 2020 in the US. US 108 billion. That's a global figure, about 70 billion in the US, and 10 billion in US for influencer marketing, global influencer marketing budgets, and we're in that space as well. And 28 billion international. And the space very specifically is called programmatic advertising. So that gives you a little bit more insight. We can go to the next slide now. These are our brands, Engage BDR. We've been around for 12 years, so people have, we're pretty popular. We've been some of the founders of the company, myself, board member Tom Anderson. Tom Anderson was the founder of social media and in MySpace, and I was on the executive team as well in MySpace. So we've been in the industry for a long time. Iconic Reach is an influencer platform, our influencer marketplace, which was designed by Tom Anderson, the founder of social media, or MySpace as well. And AdSell, a company that we bought in 2018, which is a great successful acquisition. We can get to the next one now as well. And essentially all of our business is fully automated. So we have about 100 billion transactions per day, or auctions per day, and it's all automated. So we don't have salespeople. We have 0 sales staff. We have a very small team of 17 people, and 17 full-time employees. They're based here in West Hollywood, California. And so we're pretty optimized. Everything is machine learning, AI, and fully automated. Next slide, please. So this is our footprint, a little bit of our key facts as well. We're in LA. We have an office there. We have an office in Kyiv. When we bought AdSell, we inherited their operation as well. And in Melbourne, we have directors that are based there. So we raised 0 outside capital until the IPO, which is in 2017. We did a couple $100 million, about 250 million in revenue before the IPO. We're profitable most of those years. Key fact, last year we did 17 million in revenue, 1.6 million EBITDA profit, and some other information here, which might be interesting to people. 11 years, it's our 12th year. Some information on the capital structure. Current price is 1.2 cents. We got hit pretty hard with all this people freaking out about, the world going away. And so we got sold into a little bit, but it's a good time to buy, I would say. 890 million. Good time to buy in general. I can't say our stock, but I would just say in general, 890 million shares on issue, 11 million market cap. Founders own about 22% of the company, about 200 million shares roughly. The top 20 is about 52% of the register. There's about 2,000 plus shareholders on the register at any time. This is our timeline, and all this information will be available later. I intentionally added a lot of extra slides on here just so people can have some background. As I mentioned, the company was founded in 2009, and there's a lot of evolution for the company here. Talk a little bit about some of the acquisitions and our return to profitability last year, our IPO, the shifts from display advertising to video advertising, from non-programmatic to programmatic, et cetera. Next slide, please. So this is basically programmatic advertising. It's an automated process of online advertising inventory through auctions, which we call programmatic advertising. These buyers are integrated through server-to-server connections. It's very technical. Each integration takes about 3 months to do. We have about 220 programmatic integrations, some of the biggest buyers in the world, as far as buying platforms, or what we call trading desks, who are integrated. So essentially how it works is people use an app, a game, or utility, and they load the content. On that page, you'll see ads. Bids are placed for those ads by those buyers. Somebody wins the ad based on their bid price, and then a relevant ad is shown to the user. So all of this happens in 200 milliseconds. And so just to give you an idea, all of digital advertising in the US is programmatic advertising. It's not a new thing anymore. It became pretty big starting 2016, but all of it now, including your billboards, taxi tops, connected television, and mobile and desktop as well. Next, please. Advertising inventory, so this is what some of it looks like. As I mentioned, connected TV ads on the left. And I don't know if you guys have Roku over there, but we have Roku and other set-top boxes and streaming media. Well, there's apps on those boxes, and those apps will include content and ads on those to monetize essentially that content. And so those are the highest CPMs right now and the highest growth areas of all advertising in the US currently. Display advertising, which you've probably seen in the middle, influencer marketing, where you have some younger people, 20-plus-year-old kids making $10 million a year on YouTube. Well, those are influencer marketing superstars, and we work with thousands of them. Video ads as well. That's our bread and butter. That's what we mostly do. So when you're on YouTube watching a piece of content, you'll see that there's an ad and a commercial, which you hate. We're responsible for a lot of that. Next, please. So our goal is, what are we trying to do? We're trying to be one of the largest programmatic platforms in Asia, or Asia Pacific. That's why we listed on the ASX. We felt that Asia Pacific strategy makes a lot of sense operating from Australia. So that's the goal. That's the reason why we came to Australia in the first place. There's a lot of great talent there that has a lot of experience with Asia Pacific, and so that's our goal. I think it's a really good opportunity and time to grow pretty quickly in Asia through organic growth, but also through acquisition. We do a lot of business in Asia currently as well. Next, please. Some of our highlights on the financial side, the assets and liabilities. So we had some pretty great contrast last year. Some highlights here. Yeah, there we go. Okay, so we have about 17 million in total assets on the balance sheet. Total liabilities are down to 13 million. Net assets are about 4 million currently. Next slide, please. Revenue, as I mentioned, was 17 million last year, which was 50% growth over the previous year. 11 million the previous year. The OpEx was about 7 million, significantly low. The gross margin was 54%. We operated at 54% margin in 2019. The EBITDA for 2019 was 1.6 million profit, or operating profit. Next, please. This year, some interim results. The we were about 303% year to date of 2019 as of end of February. March was doing really well as well. We put out those numbers. We're one of the only companies in the world that puts out our results every 2 weeks. I don't know anyone that does. You could show me a company that does and I'll be excited. But we do this to keep ourselves accountable. So we communicate with the market so the market knows exactly what's going on with us. If you look back for the last couple of years, you'll see announcements from us frequently about our revenue and about what's going on with the business. So about roughly every 2 weeks, or we have a mid-month, and we have a monthly recap of how the revenue was for the month. And it's enabled us to be pretty accountable, and people give us a lot of great feedback saying that, hey, you guys are really communicating well, and no one else communicates like this. So for us, we do this because we want to gain credibility and accountability, and keeps us accountable to our shareholders as well, who are our bosses. So this year has been pretty good so far. Some comparables to give you an idea. The Trade Desk is a NASDAQ company. They do exactly what we do. They have a $14 billion market cap. They're trading at 24 times revenue, 140 times EBITDA. AdSlot is a company on the ASX. It's an Australian company. Their market cap's about 45 million right now. They're trading at 5 times revenue or so. Our market cap's 11 million. We're trading at 0.6 times revenue. So as you can see, it's pretty lean. There's a lot of room there as far as from a valuation perspective. And our EBITDA, we're trading at 6.8 times EBITDA. So you can see and we're profitable, and many of these other companies are not. So that gives you a little bit of insight as well. The board, as I mentioned, I'm ex-MySpace, one of the original people that was a part of the business when it launched. From inception, I was also part of a company called LowerMyBills.com, which we sold to Experian for nearly $500 million USD. I started my career in the mid-90s in Silicon Valley, so I've had a lot of experience, and I'm pretty old. Board is comprised of very experienced people. Tom Anderson, as I mentioned, arguably the founder of social media, also the founder of MySpace, who I work very closely with for now 17 years. Rob Antelov, he is on our board and very experienced in the M&A space and corporate development. He's based in Sydney. And Darian Pism as well. He's our non-exec director in Sydney. He's a very smart guy. And thank you so much. Feel free to reach out to me, ted@en1.com. If you have any questions, I'd be happy to answer, as long as they're not sensitive and they don't send me to jail.
Ted, a great presentation, and thank you for getting up early to give this presentation, or staying up late, whichever it was. Clearly a business that's playing in the right space in a market that is growing, and getting a big market that's getting bigger and bigger, this programmatic ad market. A great presentation. There are no questions, so I can let you off the hook. I have one question for you. In the space that you're in, how active is M&A? And do you think you will be a company that will play actively in that space as someone looking to make acquisitions?
I think that's a great idea. We're looking for deals all the time, and I think that everyone's been impacted in our space somewhat, or a certain extent. I mean, companies that we've had conversations with on the average have been impacted 70% here in the U.S. from a revenue perspective. Based on our recent announcements, we're roughly between 30 and 40% impact in March. And so, April's looking better. And because of that, we think that there's going to be cash crunches for private companies, and there'll be opportunities for us to buy. Now, I think that from our perspective, what's really important to us is we need to make sure that our market cap and our assets and our balance sheet can support any of these types of deals. What we find is that there may be opportunities for companies to continue operating through acquisition rather than looking for an exit and see an exit another day in the future. From our perspective, we want to prevent dilution, so we got to be really careful about how we do these deals. We really don't want to issue a bunch of shares because we think our share price is extremely low right now. It's the lowest it's ever been right now. And I think that, you know, that's advantageous from the perspective of like the fund that we just heard from in the beginning, the first presentation. They're looking for deals like this, right? And so I think, but from our perspective, we don't want to issue shares to buy something, and we don't want to issue the cash because we need the cash to grow. So it's a little scary, you know, from that perspective. But the debt out there is really cheap. So we're looking at debt, and we've applied for some straight debt opportunity with Australian banks. And so we're looking, you know, for responses to that soon. If we could raise enough money through debt, then I think it could be a viable solution to make acquisitions. But I think that would be 60 days down the road when we start really seeing people feeling some pain, I think.
There's a question, or a couple of questions have come in relation to ad slot and how you compare or not to ad slot.
Sure, that's an easy one. So ad slot is, they play in a, I like these guys, but I'm not, they're a totally different business. They're a programmatic ad company, but they're not in the same space. Now they're on the demand side. So they license a piece of software to agencies, very specifically to agencies. So they're a SaaS solution, and that they're making some money on media as a commission or something like that for media traded on their platforms. But the only type of media that they're trading is called guaranteed premium. So it's on a flat rate CPM, and it's not an auction-based system. Now, 99.9% of all media traded in the US is on an auction-based system. It's real-time bidding, open RTB. So we picked the biggest dartboard to throw the dart at, and that's the one. Now, there's a smaller dartboard to throw a dart at, and you want to be niche, and I think it's going to take a longer time to grow. So they're on the demand side, meaning they work with the agencies and the brands. We're on the supply side. So we work with thousands of publishers direct. So that's the difference between our businesses. We own all of our technology. 100% of it is proprietary. There are probably billions of lines of code. It's developed over 12 years. Auctioning systems, as I mentioned, we host 100 billion auctions a day. There are very few companies that do that. We're up to about 1.5 million auctions per second at our peak. So it's very, very difficult technology, and you got to hold those auctions for 200 milliseconds to be able to, you know, conclude those, to serve an ad and conclude an auction. So from that perspective, from a technology standpoint, I could say that nobody that's been mentioned in this conversation has technology that's robust like that, except for us.
And in terms of ad blockers, do they affect your business at all?
Absolutely not. Ad blockers are something to worry about on the web. We're all app. You can't block ads on apps. And also, you know, it's negligible. It doesn't impact our business at all. We don't even notice it. And the reality of it is those users you don't want anyways, because they're users that are pirating your content for free. It's essentially pirating, right? It's kind of like when people were downloading MP3s on Napster for free, they didn't want to pay for the music, right? Well, this is the same thing. They don't want to pay for the content, so they're using ad blockers. But no, it doesn't affect us. The SDK on the app, on the device itself, circumvents anything else that they could put on the app to block any ads. So it doesn't impact app traffic. And you can't put an ad blocker on your connected television. And that's what we really care about, is connected television. So no, it doesn't impact us. We're not on the web. We don't do anything on websites. We don't want to play in that world. The CPMs are too low. Our CPMs are 10 times greater than that, at least. So you want really robust targeting capabilities. It's app users. You get latitude, longitude. You get so much more behavioral data on the user. It's rich. On the web, you get none of that. You get an IP address on the web, and you know what? You might be in Sydney, but it says you're in Egypt. Literally, those IP addresses are useless. So we don't really want the web. We don't care. We left the web in 2017. It's from our perspective, it's the smaller opportunity.
Well, as a founder of MySpace, clearly a visionary in the technology space, and with the Engage BDR, achieving significant success and more to come, no doubt. So Ted, thanks for a great presentation.
I appreciate your time, David. Thank you so much.